Hey, what is up, bubs? Welcome to The Basic Concept. Thank you so much for tuning in. And today I want to talk to you guys about the current pandemic and its effects on the stock market, and why, especially now, buying value is the most important factor in building your wealth. So what does that actually mean, buying value? So when you look at buying into a stock or an index fund or a mutual fund, you can take a look at two different things. One would be the price itself on it and how it's trending, or the actual underlying value, what it brings in. That value could be as simple as a dividend that it brings in for you to create income or passive income for you, or to compound it further. Or it could be a growth stock or a mutual fund or index, where it's just looking at the price action of it for the last week or last month and then deciding whether you want to buy into it or not. Let me paint a picture. Imagine going into a store and not seeing any products, but only labels that have pricing on them and a price action for the last week or the last month. That's basically what buying price is, and it's pretty much like buying into the hype. And unfortunately, most people that fall into this are retail traders like us that have no idea what they're buying, what the underlying value of their assets are, or what they currently own in their portfolios. Versus buying value would be what you're actually trying to get out of that, whether it's growth, long-term or short-term, or if it's dividends. So imagine going back to the same store, but this time all of the products have descriptions on them, like features and functionality, but they all have the exact same price. So if you do your research prior to going into that shop, you would know what features and functionality you're looking for, and it will help you narrow down your choices drastically, and it will make that buying process super easy. For me, most of the long-term investment that I have, my underlying value that I'm looking for is dividends, and dividend growth specifically. The difference between a dividend stock and a dividend growth stock is simply just how often they raise their dividend to match the market or to compete with inflation. And this is the biggest reason why you always hear me talking about the yield or the dividend yield that the index or the stock is bringing in for me. Now, most often than not, if I'm buying an index or a stock, I'm buying it because of the dividend that it brings in. The growth factor does play a little bit of a role into it, but it's not the deciding factor when I'm looking to purchase. The dividend yield is probably the most important factor that I look into when I'm looking to buy an index or a stock in general. So let's talk about what's going on in the stock market currently with the pandemic. So you can see the stock market is kind of bouncing up and down almost daily. A world event such as the coronavirus outbreak creates like a little bit of a panic between all the traders. Retail traders specifically don't respond well to panic, and they usually tend to panic sell their shares, which is the first layer for the stock market crash. Now in the market, there is something called stock shorts. Basically, these people sell shares without actually owning them, and they buy it back on a dip to make their profit. And that's the second layer. The people who are actually shorting the stocks at the top of the market, knowing that the panic is coming, and then knowing that the panic sell-off is coming as well. When these type of traders see an incoming panic, they'll short stocks hoping for the downfall of the stock market so they can cash in when it goes down in price. So now the market is going to be flooded with two types of different sellers. One are the panic sellers that are actually just afraid of losing too much value of their money, and they just want to cash out because of the pandemic. And two would be these shorters that are coming in to also sell and try to make a profit on the downtrend. And this causes an imbalance on buyers versus sellers. There's more sellers in the market than there are buyers. So the stock market does go down a little bit. Now the difference between the two sellers are the shorts, the people that are shorting the stocks, they do have to buy back the stocks in a certain amount of time to be able to fill back from the firm that they bought them from. Now with this current event, the stock market is fluctuating quite a bit, almost daily, and this allows the shorts to be able to get their money back and lock in their profits a lot quicker. And now these sellers are turning into buyers. So now they're buying back the shares, but the market sees it as more buyers than sellers, so the price goes back up a little bit or fluctuates pretty much on the daily. Now obviously with the stock market, this isn't always the case. So this is not 100% of what's happening out there. There's always other factors that are going on with it as well. But this is these two particular layers do play a big role. So with all that said, is it time to buy? I personally did, but that doesn't mean that you should as well. Myself and pretty much anybody that's in the market has no idea what's going to happen tomorrow. If this is the bottom, or if it's going to keep going down, or if this is like a temporary thing where it's going to bounce right back up. No idea. Nobody knows what's going on. Nobody has that crystal ball. I bought specific shares to lower my cost average for each one of those funds that I have in my portfolio. The indexes that I recently invested into, I already owned a bunch of them previously, so just having more added on at a discounted rate actually helps my cost average. For example, if you bought a share of a company that's trading at $100 and then it goes down a little bit, goes down to $90, you buy another share, and then finally it hits the $80 mark and you buy a third share. You spend $270 total to buy 3 stocks. So even though your first stock was $100, your net average cost for all 3 of them are $90 each. And cost averaging is actually a really good tool because none of us can really buy all the shares that we want at one given time. We're basically adding increments to our current standing of any of the funds. So when you're buying a fund, say at $100, and then tomorrow it goes on for 90, you're buying the second set at $90, but you're lowering your total cost of acquisition for the entire fund that you own. So back to value. For example, a lot of the funds that I own and are looking to buy more of, they have a 4 to 5% dividend yield. So if I'm buying a fund that's $100 and it pays me back $5 every year, whether the fund stays at $100 or drops down to $80 or $90, it doesn't really affect me. I'm still getting the $5 a year on the initial investment that I put in. My whole goal with the market is basically utilizing compound interest to multiply my money. So if I put in $100 and it keeps on bringing me $5 back every single year, it doesn't really matter if the underlying value of the stock is $100 or not. I've already gotten paid multiple times over for that particular ownership. And that's the way you kind of have to look at the stock market. You have to see what the underlying value is that it brings to you particularly. Otherwise, you're just buying hype and you might lose money more often. So for me, I'm going to continue lowering my cost average by buying more and more shares, as many as I can afford during this time that everything is on sale. Now, every situation is a little bit different. Yours is going to be different than mine, and so is going to be the next guy. And I don't know your personal finance situation, and I'm not your financial advisor. So take this video as an informational video on what's going on with the market, not financial advice. And that's going to do it for this particular video. Stay safe out there. Like the video if you found this information useful or helpful. If you haven't already done so, hit the subscribe button. It helps my channel grow, and I do bring in new videos about personal finance and money every Monday. And as always, thank you for watching. We'll see you next time.